Imagine trying to raise the first money for your startup, but instead of a check, the investor hands you a 20-page contract which is full of traps. Liquidation preferences, veto rights, and dilution clauses. And all of those things at a simple pre-seed round. Unfortunately, the reality is that a lot of first-time founders get scammed and pressured by experienced investors. And for us, during our first pre-seed round, this happened as well. So this is part 2 on how we missed out on another 200,000 euros when trying to raise our pre-seed round. If you haven't watched part 1, check it out right here. This is where I tell the story of how we went from a handshake deal to being screamed at on the phone by the same investor just a couple days later. Hi, I'm Simon, and this video is part of a series where I revisit moments from my startup journey to reflect for myself and to talk about the mistakes that I made so you can save time, money, and mostly your nerves when scaling your own company. Don't forget to subscribe to my channel if you don't want to miss out on weekly videos about entrepreneurship, self-improvement, and personal growth. But now that this is out of the way, let's get straight into the video, because today I want to talk about the big and costly mistake that we made as inexperienced founders when fundraising for our startup and the insights we had to learn the hard way. The story starts after Mike, the investor of part 1, left pissed off and walked away from the deal. However, as I mentioned in the first video, getting the first hard commitment from Mike really kicked off the pre-seed round for us, because the good news actually traveled very fast and a lot of investors started reaching out to us. So naturally, over the next couple days, we met with a lot of investors. Some of the conversations were dead ends, while others showed actually a lot of potential. One of those conversations was actually with a German investor who showed a lot of interest in the concept, liked the team, and also saw the early traction we had. Let's call him Theo for the sake of this story. And with Theo, everything went super quick. We just had an introduction call for about half an hour, another call with his business partner, and after just 2 meetings, they sent over a term sheet with their recommendations on how they would want to structure the round. And right off the bat, the difference between Mike and Theo couldn't have been more different. It was basically like night and day. Because with Theo, it felt like we were stepping into a corporate M&A deal instead of a scrappy pre-seed round. But once we started reading the term sheet that he sent us over, we actually started to discover a lot of things that seemed a little over the top. The first thing that we discovered was something called liquidation preferences. Signing a liquidation preference basically means that as soon as the company gets sold, Theo would get his money back first, sometimes even multiple times before the founders even see 1 cent. The second thing we discovered was an anti-dilution protection, which basically means that if we raise a round at a lower company valuation, he'd magically get more shares in our company. And the third thing was a veto right when we as founders actually wanted to sell the company, which was effectively giving him the power to block us as founders from selling the company. And I'm not saying that it's completely weird to include those kind of things in a term sheet, but you have to remember that we were not trying to raise a big, serious corporate Series A round. All we were trying to do at this point was just to get a small and quick pre-seed round together in order for us to further validate the early traction that we had. In the beginning, we were trying to convince ourselves. We were thinking, yeah, maybe this is normal, and we are the inexperienced one, and maybe we just don't know better. But the deeper we were digging into this term sheet, the scarier it got. And once we finished reading the entire document, it felt like we would basically sign the whole company away before it even started. You could pretty much compare it to signing a prenup before going on a first date. No one would ever do that. Naturally, the next thing for us to do was to schedule a meeting with Theo to confront him on the very founder-unfriendly term sheet and to actually push back. So once we started sitting down with him and actually started to push back on a lot of points in his term sheet, and the first question he asked almost casually was, "Who gave you legal advice?" And in that moment, everything clicked. Because up until this point, he has been very friendly, supportive, and encouraging. But the second he realized that we were not the founders who would just blindly sign anything he sends over in order to get a huge check, his mask started slipping. Because from 1 second to another, Theo actually dropped the nice guy attitude and turned cold, almost hostile. And again, just like in part 1, we were blindsided by this shift of personality. Because all we asked at this point is just to keep it simple. We didn't want any lawyers to be involved. We didn't want any complicated financial structures or term sheets. We just wanted a clean and simple deal. Luckily, his reaction showed us everything we needed to know about him, that we were right about our gut feeling, and that we actually dodged a huge bullet. Walking away from another 200,000 euros obviously hurt. But in the end, our gut feeling was right about the guy. If this was how he was reacting now when nothing was on the line, just imagine how much worse it would have gotten in the future when there would actually be a lot of money involved. In the end, we didn't walk away with empty hands from this interaction, because the learnings we had from this were super valuable. So let's dive into what I took away from this experience and what you should definitely avoid when raising your pre-seed round. The first and obvious thing is that pre-seed rounds don't have to be complicated at all. And in my opinion, they also shouldn't be. My advice is to keep it clean and uncomplicated. This could be either a simple safe, convertible note, or a straight up equity deal. One thing you really don't need at this point is a 20-page term sheet with corporate lawyers breathing down your neck. Because especially in the early stage, it is absolutely crucial that the founders can focus on validating and scaling and pushing the business instead of wasting time on any legal battles or political games. And you should have an investor who understands this, who understands you, who understands the business, and who always has your back and is in your corner. The second thing is, just like with dating, that red flags matter. If an investor is already trying to lock you in with unfair terms, just imagine how much worse it will get in the future. It is important for you to know that there are founder-friendly and founder-unfriendly term sheets that investors send out. And when you read a term sheet, you should definitely be able to put it in one or the other bucket. Just to give you some context, in our case, Theo wants to invest with a lot of upside but with minimum risk. And if we would have signed his term sheet, it would have not been a good deal for us at all. People that invest into early stage companies have to accept that it is one of the most risky things you can do with your money. And rolling that risk over to the founders is simply not fair, because the founders should be the most rewarded people when they actually hit success with their business. And that fact should be understood by every good investor, because the more incentives the founders have, the harder they will work on the company and the higher the likelihood of success in the end. And the third and last tip is to don't trust anyone and go with your gut feeling. We all know that business is a shark tank, but we had to learn that the hard way. Because Theo acted like we didn't know what we were doing, and he tried taking advantage of our inexperience despite acting all nice and supportive initially. The only thing that you can really do is to make sure that you read and understand everything that you're signing. Because against a guy like Theo, you don't want to go into a legal battle. So there you go, missing out on another 200,000 euros was obviously super painful. But in hindsight, it was a blessing. Because not all money is good money, and having a bad investor on board will cost you more than you will gain. So we first missed out on 200,000 euros on a screaming phone call, and then another 200,000 euros to a legal jungle and an investment chart. But eventually, after all those learnings, we still managed to raise over 500,000 euros from trusted investors, which were the right partners for our company. However, of course, raising money is just the start, because spending it without blowing up the company is arguably even harder. But thank you for watching the entire video. Let me know in the comments if you have experience with fundraising, and don't forget to like and subscribe, and see you in the next video.